You might think that when a company delivers earnings that beat expectations, the stock price should go up, but after Arista Networks released its Q3 earnings, the stock at one point plunged more than 10%. The issue wasn't the numbers themselves. What the market was really worried about was whether the company could continue to execute perfectly from here. Today, we're going to break this down clearly. Hey everyone, welcome back to Deep Dive Stock Earnings. Today we're focusing only on Arista Networks. Let me put the conclusion right up front. This was not a problematic earnings report. On the contrary, it was a very strong one. The problem is that the market has already treated strong as the default. What actually drove the stock's volatility was forward guidance and strategic choices, not Q3 itself. Let's first lay out the hard facts from Q3. Arista reported non-GAAP revenue of approximately $2.308 billion, up 27.5% year-over-year, clearly above market expectations. Diluted EPS came in at 75 cents, up about 25% year-over-year, also beating consensus. Profitability remains extremely strong, with a non-GAAP gross margin of 65.2% and a non-GAAP operating margin close to 48.6%, which is top tier in the networking hardware plus software industry. Quarterly non-GAAP net income reached about $960 million, representing more than 40% of revenue by any traditional earnings metric. This was an almost flawless report card, and precisely because of that, many investors felt confused at first. If everything beat expectations, why did the stock fall? The answer is actually simple. The market wasn't looking at Q3 at all. It was already pricing in 2026 when a company is trading near historical valuation highs. Any signal that future margins might come under pressure gets amplified. Once you shift the focus to guidance, the market's real concern becomes clear. The company's Q for guidance remains solid, with revenue expected between $2.03 and $2.04 billion, and non-GAAP operating margin holding at 47% to 48%. But the more important part lies in the medium and long-term targets. Arista reaffirmed full-year 2025 revenue of roughly $8.87 billion, implying 26% to 27% growth, and set a 2026 revenue target of about $10.65 billion, even on a high base. That still requires close to 20% growth, which places extremely high demands on execution. These growth targets are almost entirely anchored in AI. The real question isn't whether AI needs networking, it does. The question is how much Arista is willing to give up in order to capture that opportunity. And the cost hits the market's most sensitive nerve, whether margins can remain at current levels over the long term. The company disclosed that its AI-related networking revenue target for fiscal 2025 already exceeds $1.05 billion by 2026. AI data center-related revenue is expected to reach about $2.75 billion. Implying year-over-year growth of 60% to 80%. This means Arista is concentrating resources heavily on AI networking for hyperscale cloud customers. At the same time, it continues expanding into adjacent areas like campus networking. But the core driver of overall growth remains AI data centers. What truly made the market hesitate was Arista's clear stance on the blue box model. Simply put, the company is willing to prioritize larger hardware shipment volumes by allowing certain customers to use open source or customized systems instead of the full AI software stack. This isn't a capability issue, it's a very deliberate strategic choice. The implication of the blue box model is straightforward. The software and services value per unit declines, which naturally puts pressure on long-term gross margins. The company didn't avoid this reality and has already guided for gross margins of around 60% to 64% in 2026, clearly below current levels. This isn't a loss of control, but a proactive decision to trade margin for core AI customers, scale advantages, and influence over industry standards. The real question is whether the market is willing to pay today for that future scale. When a stock's valuation already assumes years of flawless execution, any strategic shift, even one initiated by management, tends to trigger a short-term valuation reset. This sell-off looks more like the market recalibrating expectations. Are you willing to accept temporary margin concessions in exchange for longer-term growth? The hesitation from capital itself is part of the answer. Looking at price action, on the day earnings were released, A Northeast dropped more than 11% intraday, before staging a partial technical rebound, but it still significantly underperformed the broader market. This reaction isn't a rejection of fundamentals, but a repricing of the combined risk of high valuation and high execution difficulty. When a company is expected to beat expectations every year and never miss a quarter, earnings are no longer a bonus to become the entry ticket to the next phase of the game. The stock price now reflects not what the company earned today, but whether future execution can continue to stay ahead of expectations. Putting everything together, this pullback wasn't caused by Arista doing something wrong, but by choosing a more difficult path with potentially higher long-term rewards. The opportunity in AI networking is massive, but the bar for execution has never been higher. Do you think the market is being overly cautious, or is it proactively managing risk? Share your view in the comments. This is Deep Dive Stock Earnings. See you next time.